the live trading question and answer session, but absolutely on the live trading day, which is where Scott St. Clair from Morgan Smith will be here demonstrating this software as well. Quick housekeeping note, reminder that tonight, 6 p.m. Eastern time today, rather 6 p.m. New York time will be the replay of this morning's session. You are welcome to come back and watch it again, which I highly encourage. There's a lot of information that you guys are getting. Of course, the more you see it, the more you'll absorb of it. And finally, we are on the last session, A Picture's Worth $1 Million, page 106. This last session should last just about an hour, and we'll wrap up then at that time or after the session's over. For the question and answer session for tomorrow, you can email me questions that you have. Try to put them all together on one email. Don't send me 5 emails for 5 questions, please. And that will be something you can do after the session today, and that will get us ready for tomorrow's Q&A session with Mark. All right, let's get back to Mark and Mark for Picture Worth $1 million.
Okay, welcome back, everyone. We're going to just recap real quick here. Categories. We talked about categories and catalysts. We talked about valuation, the trend, the 4 stages of a trend, and we want to be in the stage 2, of course. And then we just spoke about fundamentals. Remember, with fundamentals, I'm looking at 3 things: earnings, sales, and margins. Bunch of ways to slice and dice it, but the main things I'm looking at are earnings, sales, and margins. And the real key is to always compare those and use differential disclosure to make sure that it makes sense. You know, if you got the earnings and the sales and everything looks good, that's great fundamentally, but you still have to make sure it's confirmed by the technicals. We're going to get into some of the technicals now. And again, we are still in a mode of aerial mode here. All right, we went from satellite to aerial, and we're going to start zooming into overhead here soon. But we're going to start off with some perspective here, and this section, A Picture is Worth $1 Million. We're going to identify the price action and look at what we're looking at technically to again confirm that differential disclosure. Confirm that those fundamentals are indeed being recognized in the marketplace, and that institutions are in there buying the stock, and we're not swimming against the tide. So first thing, and I used to pose this as questions a lot of times when we did the in-person events. There's 3 things here: the long-term trend, the current price action, and a low-risk entry point. And in chronological order, it's real important that as we're going through this in chronological order, you understand that there is a chronology to this. It's real important. Like the current price action is meaningless if it's not within a long-term uptrend. As a matter of fact, it could mean just the opposite. If you have, a stock maybe forming a base in a long-term downtrend, it could be a short. That would be what we call a ledge, and we would be looking to short it. So, and the low risk entry point is only going to be as good as where it resides within the current chart price action. So, and the fundamentals are only going to be as good as they're being confirmed by this price action. So there's a chronology, and everything's relative. So again, your shorter term trend or your shorter term price action is only as good as the long term trend, and the current entry point is only good as the current or the shorter term action is only good as the intermediate term action. So now there's a number of, we can get into the names. I don't usually like to get into too much of labels, but you're going to hear cup completion cheat, load cheat, cup with handle, which you know from William O'Neill, of course, double bottom, Darvas box, power play. These are basically the 5 technical patterns, if you will, or price action that we use. Now, really, we don't really go outside of this very much, and we're going to talk about volatility contraction pattern, and that's pretty much a characteristic of all these various patterns or vernaculars that we're going to use. The time that we're going to spend in or looking for stocks and bases and consolidating before we buy in this stage 2 uptrend are going to be anywhere from 2 to 6 weeks to as much as 65 weeks, depending on how what the market is like and what we're getting as far as coming from the individual stocks. So a few things that we need to talk about, and one is, and again, it's not enough just to show you what works. Okay, I can show you what works, and you might not be able to follow it, or you won't have the conviction to stay with it. You may have tough sledding for a little while, and you'll give up on it. The real key here is not only to show you how to do this, but why it works, what is the reasoning behind it, what are the facts, because then you have some real conviction and belief in what you're doing, and that's what will carry you to the finish line. Because a coach's job, whether it's a football coach, basketball coach, any kind of coach, the job of a coach is to teach and to teach how to do things, but the real job of a coach is to create confidence and belief in the team, in the team's process, and in the players themselves, and the people themselves. You have got to believe in what you're doing, and you got to believe in yourself. You can do this. I assure you, you can do just as good as I gave Mark Ritchie this speech 13 years ago, and here he is today. I gave this speech to a lot of people. You can do this. You can do better than me. You can do this better than me. You now have the benefit of me sharing with you from my mountaintop, which now that cuts off a whole lot of work for you, and you can climb a higher mountain. So you can do this. But there's certain things you have to understand, and you need to know why we do what we do, not just what we do. So we buy stocks that are in uptrends. We buy stocks that are trading near new highs, sometimes all-time highs. There's the reason behind that. It's not only because when we go back and we look at the stocks that made the biggest moves, that those were the characteristics they had, but there's a very logical reason. An Amazon cannot go from $50 to $1,200, or a stock goes from $1 to $20. A stock cannot make a gigantic move without making new highs. It's impossible. There's only so much it can go. Even if it had a big decline previous, even if the stock went down 90%, it corrected 90%, well, it would have to go up 900% to get back to break even. But 900% could be just the beginning of a Cisco Systems or an Amazon or Netflix that went up 80,000%. So it would be the tip of the iceberg, and you're in new high ground. So you new highs. And if you go and you take a look here, this chart shows that these little dots that are on the chart, these black dots that you can see, are all strung together. And this is something too I want you to talk about, Mark, how this comes in bunches. You always talk about bunches. It's a good time. This is perfectly illustrating how these moves come in bunches. And I know you relate that to the stock setups, but I think here we can also relate it to the new highs. You can see that all the action, all the gain is happening in new high ground. And the other time you're moving sideways. Remember, again, we're going to go back to the beginning. You're either losing time, right? Losing value, or both, or gaining value. So when you see there's no dots, everywhere where there's no dots, you're losing time or value. The only time you're gaining value is when there's dots, new highs. This is Microsoft. Let's look at a couple here.
Just to add too, Mark, you look at that chart, just look how orderly in a number of these moves too, how the stock just quickly continues to move into new high ground. And part of that is also because, when stock, think about the psychology, when a stock makes new highs, no one's panicking. No one, no one is screaming sell, or this is why, these stocks, and when they get, especially when you combine this with, it's in the stage 2 and in its earnings cycle, it methodically has a way of continuing to make new highs. I look at this chart and I go, if you just bought every new all-time high with a tight stop, in this stock, it's a winning proposition, because you only have to catch a few of these really nice runs and cut your losses quickly, and you can make an awful lot of money. And that's the power of these stocks. When you're going to hear us talk about tennis balls and eggs, and stocks that quickly get into new high ground are the ones telling you that those are the ones you want to stay with and want to keep a position in.
And the reason why that's true, where you can, what Mark Ritchie just said, you could buy, if you just bought each all-time high and put a relatively tight stop, you made a fortune here, is because of the tailwind, because it's in a stage 2 uptrend. It's got the earnings, the institutions are, and they're supporting it, and they're fueling this. Okay, so let's look at another one here. Let's look at Monster. We talked about Monster earlier, so take a look at Monster. Look at all the price progress. It looks very similar, right? It could be Microsoft. All the price progress, it has black dots, and all the time where you're losing time or value has got no dots. So again, to make that big move, the stock has to go to new highs and all-time highs. It has to make all-time highs. So the first rule is you can't be afraid of stocks that are making new highs. Now, a stock will top at an all-time high too. Obviously, somewhere along the line, it makes its last high before it makes a big decline. That's another conversation. All right, we're going to have that later in selling. But a stock cannot make a big move. Now, earlier I said, well, the stock went down, 90%, 900% would be a big move, right? And that would bring you back to break even. So, but again, Yahoo went up. When I bought Yahoo, from the point that I bought it, went up 8,000% in just a couple of years. And this is showing 4,300% of it coming from right where I was buying it. I was actually buying it right here in 97. That stock had a correction and had gone up already 170%. But the big move was all in new high ground. And I actually bought it here. I bought it coming out here. I bought it over here. I bought it coming out here. I bought the stock a whole bunch of times along the way. And
I want to make the point too, Mark, that often, some people think, oh, well, if it's this obvious, why doesn't, lots of people do it? Most people do not buy stocks that are making new all-time highs. In fact, they have a problem. They want to buy stocks that are making new lows or stuff that's pulling back. And I was one of the first master trader programs. I think you started this section by saying, who here wants to buy a stock, at new all-time highs? And I stuck my hand up, and there was like, you look around the room and 80% of the hands are down. It takes some getting used to, but the whole point here is, this is where the power really is. If it's going to make an enormous move, it's going to continually be making new all-time highs.
Okay, Mark Ritchie just made a really, really great, or asked a really great question. And I want to give you the answer. And is if it's so obvious, if it's so easy as buying stocks at new highs, which it's not easy, there's more to it. Why isn't everybody doing it? Why isn't everybody doing a particular strategy? If you've made all this money, you've done so well, why isn't everybody doing this? Why? The secret is out. I wrote books. Bill O'Neill wrote books. Well, let me ask you this. Why isn't everybody thin and in shape? I mean, everybody knows you exercise and you eat healthy, or you eat less and you exercise. Why isn't everybody in shape? Because, well, first of all, that's not a priority for everybody. Second of all, discipline. Discipline's the real reason. Discipline, skill, knowledge, belief, dedication, all kinds of things that go well beyond just the information. Just because you have the information doesn't mean anything. It's what you do with the information. And it's not a straight road to success. There's a, just like if you're overweight, you don't just go from being 100 pounds overweight to being in shape. There's a lot of work. There's a lot of dedication. There's a lot of belief. There's a lot of tough days along the way. So no different. That's why.
Another golden tangent, and for success in anything in life, by the way, not just stock trading.
Yeah, absolutely. So Taser, here's another one. I was actually buying Taser past this point where it started making new all-time highs here. But again, see all the black dots? See, all the progress is made in black dots. Stock from the lows, it had a big correction, went up 540%, but the big move was after it was already in a stage 2 uptrend, a powerful uptrend, making new highs. Stock has to make new highs to make a big move. All right. So again, we'll give you a little perspective here. When do you look for stocks making new highs? One of the best times, and we happen to be in a bear market right now, this is the time where you want to start looking real carefully for the stocks that are trading near new highs, because big winners emerge from bear markets and corrections. Now, so where do you start looking? How do you know? How do you know when to start looking for these? Well, once you have a correction, you start looking for the stocks that are acting the best, and the market may not bottom. It may not even bottom yet. When you go back to, and I'm going to show you some examples here. You go back to 1990, you go to these various times where we had bear markets and we came out of those bear markets. I was buying names sometimes that were making new highs and in a stage 2 uptrend while the market was in a stage 4 downtrend and making new lows and hadn't even made their final lows yet, where sometimes they were a months later before the market even started moving up very well. And I'm going to show those examples here, but there's 3 places that we're around when you're bottoming. And the reason why I'm going to talk about this now is because we happen to be in a bear market right now. Predictive is where you have stocks that set up and they start emerging and making new highs before, and you're only going to know this in hindsight, by the way. You're only going to know this in hindsight. You're going to see the market maybe is turning up. You get some stocks setting up, breaking out of bases, moving to new high ground, but then the market goes to lower lows. Now you will know that that was a predictive setup, and you've got to judge it and see how it's acting and so forth. It might not act very well and the market goes to lower lows. It may. That's a predictive setup. Then you have coincident. Coincident setups are ones that happen right off the market low. And when it's the final low, before you go from a bear to a bull. And again, you won't know until hindsight. In hindsight, you'll know. Then you have confirming. Confirming is when you've already made the low. The market has either marked itself up a bit or has backed and filled and moved sideways. And those are stocks that start emerging with the market. As the market is in an uptrend, they start to emerge. The answer is that in all these points, you're going to be looking for stocks that are making new highs and holding up the best during a bear market. And you're going to be probably buying stocks along all of these different areas, sometimes more than others. I'm going to show you how this pans out in real life. Well, first, let's just take a look here. Predictive. So market comes off, stock sets up, starts moving. And I'm talking about setups. I know I'm moving ahead here. I haven't even shown you what a setup is yet. We're going to get to that. Okay, we're going to get to that. Another thing I want to say real quick is we're going to have a Q&A. Okay, it's real important that if you have questions, because we're not allowing questions during the curriculum, you write them down. And I would write them down in the books or a piece of paper, maybe a sticky, put it in, relate it to the chart, because we can go back when we have Q&A. You tell us the page, and we'll go back to that page. We'll bring it up. You ask us the question, and then we'll discuss that chart for everybody to learn. It's very important that with that Q&A section is really important, and that we go back to the specific charts so we have the example to go along with your question and the answer. So predictive would, and we're going to show you real examples here. I'm just going to give you the concept here. Predictive would be you're breaking out of a base before the market makes a low. Coincident would be stocks that come out and start emerging right around the time of the low. And confirming would be with the market after the market has maybe made a low, moved up, and now you've got a lot of stocks start chiming in. Let me show you how this works in real life. So, and this is where you're going to learn how to, and you're going to develop a skill of finding the best names, and the names that are having high relative strength, and their relative strength lines are improving, and without even having to look at relative strength numbers or relative strength lines, which doesn't negate the fact that you shouldn't be. You should be, and you can use it for screening. Certainly in MarketSmith, I use screening tools and I put a relative strength cutoff, and that's going to lead me. But you should be able to have the skill to look at a chart and to know if it's performing relatively good to the market and whether it's a stock that should be considered without any tools whatsoever, without any computer tools, just looking at the chart. So the way you do that is you compare the stock to the market. So this is Walmart, and this happens to be a stock that I did not trade because I was actually I was just getting into the market. This is 1982, of course. My first trade was made in, I think it was March, but it was 1983. So this was just before my time. But you could see here, you're in a bear market. And 1982 was a fairly wicked bear market, recession. You're in a bear market, and you start to come off the lows. Now, at this time, you don't know that this is not the real low. With the real low, please stand up is the big, question. When you're in a bear market, you get these bear market rallies, and then you go to lower lows. But Walmart is making a new high. Okay. And as you go to a lower low, you can see that Walmart does not go to a lower low. It just moves sideways some more and stays within this uptrend. See, you're in a stage 4 downtrend in the market and index. This is the Dow Jones, by the way, and the stock is in a stage 2 uptrend. See, so you're already seeing that drastic contrast just in the trend itself. Now in the price action, you're seeing a really drastic contrast where this stock is moving into new high ground. That's telling you that this is a potential market leader with explosive potential. Just like in the very beginning, I showed you Amgen, right? Similar situation where the market was in a bear market. Amgen was hitting new highs in an uptrend and went up about, I think, 360% precisely over the next couple of years. Walmart went up 360% in 21 months from here, and then of course went on to be one of the greatest, companies and stocks of all time. Now, mind you, when you go back to Walmart back here, I say some of these companies, and we talk about Home Depot, Walmart, Costco Wholesale, Microsoft. Guess what? When I was buying most of these companies originally, they were small mid-cap names. Walmart Sam Walton, who was the founder of Walmart, was literally standing in front of the stores on a soapbox, flagging people into the stores. I mean, this was a small company. It was a discount shop, and it didn't become the Walmart that you know today for some time. Matter of fact, there was days where Walmart traded 10,000 shares a day. People all the time say to me, "How do you trade that stock? It only trades 1 million shares a day, or 300,000, 400,000 shares a day." What are you talking about? That's what are you? Are you Fidelity? You need to go in there and buy 1 million shares? I mean, I'm buying it.
The golden nugget right there. That's opportunity. That is massive opportunity.
It's opportunity. Absolutely.
At the beginning, I've heard many people say this to Mark over the years. They'd much rather buy a stock that trades 1 million shares a day that's not going to go anywhere than take a smaller position in a stock they've never heard of that's going to double or triple in a short period of time.
Yeah, the mid-cap names that nobody heard about these. Well, even Home Depot, Microsoft. When I first started buying Microsoft back in the 1991s, it was not that many people really knew Microsoft. Even Windows, all these things today that we take for granted. Amazon, Facebook, these FANG stocks that everybody knows now. Those are not going to be the leaders of tomorrow. They're going to be new names. New names that are hitting the new highs list, that are outperforming during bear markets, and stocks that have big earnings and the potential for big earnings. Okay, so keep that in mind. Talking about Amazon, I bought Amazon originally in 1997, and we'll take a look at that buy point later on. But I bought it another time after we had the big bear market, and we had the top in 2000 when we finally started bottoming. Amazon made a beautiful new uptrend while the market was in a downtrend, and the buy point was right here. This is where I bought the stock right here. But the thing you want to look at here is you see the market is in a downtrend and the stock bottoms here. I actually tweeted recently, I said the best stocks have already bottomed, and you want to start looking for the leaders now. This is the same every single cycle. Every single bear market, the leading stocks will bottom before the market. Almost every leading stock will bottom ahead of the market, and they'll turn into an uptrend before the market does. See, the stock bottoms here, the market bottoms a year later.
Yeah, Mark, that's a really good point too. It's not just days usually, it's often months, and in this case, a year prior, this stock was already telling you it was potentially a key leader in the making.
Yes, you have tons of lead time. This isn't like you have to be watching every minute of the day and you're going to miss this. There's lots of lead time, especially in corrections and bear markets. This is where what I call you look for the sore thumbs. This is sticking out like a sore thumb, right? You can just see the contrast between the uptrend and the downtrend. So now the stock is actually moving into a new high here, not an all-time high, but a 52-week high or close to it, right off the bottom. So what is that? That's not predictive, that's coincident, right? So here's a coincident leader emerging coincidentally with the market. Now let's take a look at another one. I'm just going to give you some.
Just to point out real quick there too, Mark,
Okay.
there's also, my eye immediately, if you go forward, yeah, there's a coincident, and then there's a confirming another additional setup in Amazon, about a month later.
Yeah. Oh, yeah. Oh, you went through a number of bases here. One more thing too. Look at where the market turns into an uptrend. See, stock bottoms, market bottoms. Stock turns into an uptrend, market turns into uptrend. This is why it's called a leader, because they lead. All right. All right. Let me show you another one. One you might have heard of, Apple. So this is going back to 2004. Again, while the market is starting a correction, Apple is moving into new high ground. Right? This is a new high. And as the market goes lower, it just causes Apple to move sideways. And then another new high. And then again, the market goes even lower. And now you get another emergence here and into new high ground. So this was way predictive. I mean, you had multiple times where this was moving out of a base and going to new high ground during a correction in the market. I actually bought this. I bought this over here, and I bought some over here. I can't remember if I bought it here. I don't remember if I bought this, but I know I bought here, and I actually bought some over here. Let's see here. Let's look at eBay. So again, looking at this is a weekly chart. You can see big period of sideways action. If you were look at this stock, just look at the stock by itself, you would miss this improving relative strength, because during this time where the stock's moving sideways, the market's in a brutal correction. It's making new lows. And right off the low here, you see the market bottoms right here. The stock turns up. Stock bottomed way back here. Stock bottomed in 2001. The market didn't bottom until late 2002. 2.5 years later, or however long later, a couple of years later. And then you're emerging here right off the lows.
This is really timely for the environment we're in right now for folks as well, to say that, the key leaders have probably made the lows, to your point, Mark. It may take time, but it's worth waiting for. And they should be sticking out, like you said, like sore thumbs.
Yes. And we're going to get into what you're going to look for the current chart, the entry point, all that. Remember, we're still overhead view, aerial view. We're going to come closer and closer and closer. We're going to work our way till we get right to the day we're buying, the exact specific things you're going to look for right to the minute. All right. So we're going to get there, but it's going to take some time. Just got to give you more perspective here. So again, lumber liquidators, stock we showed before, that leverage, right? That leverage, flat market, right? Market went nowhere. It did rally, but then it had this correction. Over this time, you're basically flat, but lumber liquidator is up 90%. You can see again, it's coming out right off the lows. Coincident, right? Show you a couple more. Humana, this goes all the way back to the 1970s. I was only 13 years old at this time. I was not trading, but perfect, coming into new high ground right off the low. That's a coincident move. 1,000% in 38 months from that point. And that's from and again, I want to point out something else too. I should have said this earlier, but these prices that you'll see that might be 20 cents, 30 cents, these are adjusted for splits. That was not the price. That's adjusted for splits. So we're not going to be buying stocks. Normally, we're not buying any stocks that are below $10 or $12. Occasionally, we go into the single digits, $5, $6 might be the lowest. But those really low, the penny stocks, this doesn't really apply, to the really low price. That's what we refer to as the junk pile. You got to have some quality and some liquidity. Again, the reason why also we would stay away from the really low price, there's a number of reasons. One, they're more volatile, they're more risky, they're generally of lower quality. You're eliminating a big part of your firepower. So we want those institutions, right? We talk about the institutions. Well, when you get into a stock that's $1, $2, $3, only low-priced funds can buy them. The big funds, they can't even buy them. They're too low priced. They're not of high enough quality. They got to buy so many shares of many more shares. Imagine if you're buying a stock that's trading at $2,000 versus a stock that's trading at $2. Do the math. You got to buy $10 million worth of stock. how many shares do you have to buy? So again, you're going to defeat the purpose. You're going to move the stock, and these big funds will have a hard time buying those. So there's a number of reasons why you want to stay away from the really low price, but these weren't low priced when they were traded. These are just adjusted for splits, and because they made such big moves, it takes it down to such low prices on the scale. Let's take a look. Now, this one, of course, you remember this well, Mark, Pharmacyclics. This went up and eventually got bought 2,500% in just 42 months. This is one that I was buying, and this was actually a low price stock at the time. I don't know if this was split. I thought it was about $10, but you probably remember better than me.
This was the rare exception, and this was a power play, which we'll get into, for why we would entertain a lower price name. I did not buy this, but I was watching Mark. I think you were on StockTwits at the time, before even Twitter, saying he was buying this little stock, and this was very early in my trading career. I was thinking, why in the world is he buying this market? It looks terrible here, and he's buying this name, and of course the thing just blasted off.
Yeah, and again, like some of these other names that I showed you with getting that leverage, this is a stock that I was putting on like StockTwits or whatever, and I had a blog and said I just bought this stock here, and it was one day off the low of the market, but the market looked horrible. So I was buying this, and the next day the market made a low. So this is about as coincident as you can get, and you can see stock went up 90% during a period where the market went up 18%. So you get that leverage, and then it made a 2,500% move. So again, buying at that same spot, I would be buying at that same spot if I was going to trade it for short term or for a much bigger move. The entry point is exactly the same. Show you a few.
And just to add to Mark, sometimes these breakouts, especially when the market looks terrible, are very powerful because you'd think, well, a lot of people would buy it when everybody's scared and they're looking at the general market. They don't buy the stock that's breaking into new high ground. And that's something that you have to train yourself to ignore the index and pay attention that the stock is, again, in its own cycle and telling a different story than the general market.
Yeah. Let me show you a few more examples here. WR Grace, this is one that I bought here, and I made a nice rip on because it made such a big move in a short period of time. I saw it was really strong, so I held it longer. It went up in just 55 days, 147%. But during the time, what's important to understand or to notice is that it's making new highs as the market's coming off the lows, and going forward, the S&P's up 9%. You see, that's where you get the leverage, incredible leverage, and that's where you get that explosive potential. Same thing with Chipotle. Chipotle up 186% in 20 months from this point. Again, this is moving more confirming with the market, where now you've built that bottom, and now as you're coming up that right side, Chipotle is moving into new high ground. We can go back to, this was a relatively small company called Ballard Medical Products. I made a nice amount of money in this. They simply made for operating rooms and surgical centers. They made the soap dispensers and all the things that they had at their disposal, that surgeons had at their disposal for sterilizing and things like that. But again, you can see we're in a bear market here, right? And then during that bear market, this stock's moving sideways, and we're going into new high ground right off the lows. Again, and I'm going to show you at the weekly here that. Yeah, here's the weekly. You can see. Look at this stock. It looks like it's high priced, made this big move already. It's going into all-time high ground. See the relative strength? It's outperforming through this whole period, even leading up to, we go into that bear market right here. This is the S&P 500 right here. It's a little black line coming right off the lows. This is a new leader in the next bull market. This is where we started the big bull market of the 90s. You read about the returns that I made in Stock Market Wizards, Jack Swagger Stock Market Wizards. This was one of the stocks that I bought during that time. Amgen, we talked about this earlier. Here's another one where, look at the relative strength line. See, it's hitting new high ground, even when the stock is basically just moving sideways, because the market is going down precipitously, but the stock is moving sideways. And that's what that's what you should be looking for right now. In a bear market, look for the stocks where the relative strength line is hitting new highs. Again, this is a great MarketSmith tool. You can go in there and you can, matter of fact, they just added another one that I love. You can put relative strength line at new high or relative strength line a percentage of the new high. I think it's at 5% of a new high. And you can see stocks that are getting the relative strength line is close to making new highs. For those of you who want to get a jump on it and like to get in early.
In each of these prior examples too, Mark, I think it's a really good, where they're sort of coincident. You can just tell that once that pressure of the general market comes off the stock just naturally sails into new high ground. And it's like, I've heard people use the beach ball underwater analogy. Mark has talked about, like, the market is almost like a coiled spring sitting on top of the stock. And when that pressure comes off, the stock immediately starts moving to new high ground.
So the point that we're making here is not where you're just going to go out and say, oh, I just need to buy stocks making new highs. No, that can be a terrible strategy if it's not taken into consideration of a bunch of other factors and it's done at the right time. So we are going to be timing these trades at a specific point, specific entry point analysis. But what we're trying to make sure that you understand is that we're going to be trading. Everything we do is a continuation of an existing trend. Okay, we're never trying to buy the low. Right, we're not trying to get the lowest price. We're trying to get the right price. That's the key. You don't want the lowest price. You want the right price. You can buy the lowest price and it moves sideways for the next 5 years. And I buy the right price. I buy it much higher, but it goes up right away. And within a matter of months, I'm up 30, 40, 50%. And you wait 2 years to just break even. Who got the better deal there, right? I got a better deal at a higher price. So it's the right price that we're looking for. So we're going to get into that. Again, that's getting more forensic and moving to a tighter view here. But again, we're just trying to show you here, and you may already, be on board with buying stocks at new highs, but we got to put it into perspective and really have you understand what to look for leading up to it, and then what to look for at the moment of when you're going to make that purchase, and to just understand that the facts behind a big move in a stock. A stock can't make a big move without making new highs. It's as simple as that. So again, here's another American Power Conversion. There's always when you get these stocks that make big moves, ultimately, if you don't know the story at the time, there's always a story behind it. There's something going on that's exciting, that's new, that's developmental, that's an improvement, a better mousetrap. With American Power Conversion, this was simply, and we talked about this early on, how you've got each industry will birth other industries. Well, you had in the 1990s, this was the birth of the personal computer proliferating, where everybody, the average person could have a computer. Well, that peripherals, computer software and peripherals boomed because of it. And American Power Conversion, they came out with the battery, the battery packs and the power supplies that you would plug into, and if the power went out, and I use one to this day, I have them on all my computers, American Power Conversion, where if your computer electricity goes down, that kicks in and it protects it from crashing and losing your information, which back in the day in 1990, 91, when this stock was emerging, would have been a huge problem if your computer crashed. It wasn't like today where there's recovery mechanisms and so forth. So again, coming out and going into new high ground, and you look at the relative strength line, you can see while the stock's moving sideways and we're in the bear market, you're getting these tip-offs, new high and relative strength, new high and relative strength, and then blast off into new high ground that turned out to make a big move. Now, I want to give you a caveat here. There is a caveat to the relative strength that some people misinterpret. This is going to get a little more expert, if you will, more of an expert type observation or technique. But I've been asked this before, because sometimes I'll talk about a stock and the relative strength line is not hitting new highs, or it's even in a downtrend. So wait a minute, you said look for the stocks that are outperforming. Well, what can happen sometimes is in your prior uptrend, right, to get that into that stage 2, you get a dramatic outperformance, and then the market bottoms, right? You're in a bear market, everything's looking terrible, but there's some stock that is holding up really well, and it's moving up, and your relative strength is really strong. But then what happens is that stock had already made a big move, and it stalls out, and it has to digest that, and it moves sideways, but the market bottoms and now plays catch up to the stock. And what it'll look like is like this, where you'll see here, the stock performs amazing and the relative strength just soars. But then the market bottoms and this stock moves sideways. This is Netflix, by the way, and it's underperforming. But that's because it already outperformed. It's already the relative strength is already on the table. This is not something that you would avoid, and this may not show up if you were screening. You wouldn't pick this up with the relative strength line hitting the new high, but you would have picked it up over here, and that's where you should have put this on your radar. And again, back to Mark's point, where right now you might find some stocks that are hitting new highs, have relative strength lines hitting new highs, but that doesn't mean that now's the time to buy them. Okay, it may still take time before that right time appears.
Well,
right?
if you look at this example, great example, Mark, and a lot of these key leaders will often have doubled. That's what's going to put them in that stage 2 and put them in the proper context, and then they just need time to base. And we're going to get into the low risk entries, but here's a good example. The stock bottoms again, like you said, 3 to 6 months ahead of the market, doubles. And then, it takes almost 9 months for it really to be, an optimum buy point.
And a couple things. One, if you remember, this was the top competitor. And you remember, it didn't start emerging until Blockbuster was vaporized. Okay. Well, guess when that was? Right here. Right here. This is right when Blockbuster was finally done. They were gone, bankruptcy, and then the stock set up and emerged, and they owned the space. The other thing too, I want to go back to what Mark just said. The stock had already doubled or more and put itself into that uptrend. Let's go back and let's look at the facts. Let's look at history. When we go back and we look at the greatest winning stocks, the biggest moving, the velocity stocks, the big movers that made the magnitude moves, the average stock before it made its big secular move, the average previous uptrend or previous move was 360%. So this stock went up, I don't know what, from 18 to a couple 100%. The average was 360%, that the stock was already up off its low before it made the big move. So again, we're not looking for stocks that are down. We're looking for stocks that are in strong uptrends and have already made big moves. Let's break this down a little bit and take a look at Netflix here. So stock price is up, right, off the lows, 125%. But the NASDAQ goes on during that period to hit a new low. So you want to talk about contrast? I mean, look at these two charts. You're hitting new lows here in the bear market after a brutal decline. The 2007 to 2009 was one of the worst bear markets I've ever experienced. And this stock is going into new high ground and is up over 100%. That right there should get your attention. Now, relative strength lines hitting new highs, right? Great. My trend template criteria, if you were to run MarketSmith trend template, which back then you wouldn't have had that, but you have it now, a luxury, you can run that, and this would have came up. This would have come up on the trend template, and you said, okay, this is a stock that's in an uptrend. I got to start watching this. As the general market turns up, okay, now the market is actually the laggard. The stock already led. All right. So you can look at this and misinterpret it and say, oh, the market's moving. This stock's not going anywhere. It's lagging. No, the market's lagging. This stock has already laid its cards on the table. And now you should be watching this and looking for when it comes out of its correction and emerges. That's where now you get into that first buyable base. Once you're in that stage 2 uptrend, we're going to start looking for the first couple bases that form in the stage 2 uptrend. These are continuation patterns. We're always looking for a continuation. We're not trying to be the first on board. We're going from, the building's got 100 floors. We're not trying to go from the basement to the 100th floor. We may be getting on the 10th floor, the 15th floor, the 20th floor, and then ride it up to the 40th or 50th floor, maybe even, close to the 100th floor. But we're never going to get the low and the high, or at least almost never. And that's not the goal. The goal is to get that middle section where it's predictable, it happens fast and furious, and we're able to compound the money, and we're able to identify it and know under certain conditions what to expect, when things are acting right, when they're not, and be able to get, if that elevator cable snaps, we want to be able to get off the elevator, right? We're going to ride it up, as best we can and get off before the cable snaps. All right. So Netflix went up 500% from that all-time high, but of course went on to make a much, much bigger move. A very similar situation. And again, you're going to see these things are going to repeat over and over and over. And I've been doing this now for 40 years. This year, 2023, will be my 40th year, March of 2023. I won't want to say I've seen it all, but I've seen a lot. And I've looked at millions of stock charts. I've traded tens of thousands, if not probably hundreds of thousands of trades, but certainly tens of thousands of trades. And the same things just repeat over and over. Not only do I have 40 years of experience, and Mark has 13 years of experience doing this through his own anecdotal evidence, we've studied this stuff going back all the way to the 1800s. Nothing has changed. And that's what's so valuable about what we do, is that it's a timeless strategy. This is something that, I'm passing the torch on to you and to other people that read my books and my own family. And you can do the same. And that's what's really important here, is that this goes on. Some people will improve upon my work, just like I improved on those that came before me. And there'll be even more observations, and maybe it'll get even better, hopefully. But going back here and taking a look, FSI International, this was a stock I bought. You can probably guess where I bought it, but this shows the exact same characteristics as Netflix. You can see the market here is in a correction. Look at the relative strength. Look what the stock does while the market is going through this corrective phase. It doesn't look very deep, but it was a little correction that took some time, a year or so. Market started getting weak in 93 and didn't really get its act together until 95. FSI International, FSII, made a big move, and then see the relative strength lagged. And now it just went through this sideways action, and then from there, new high, and moves up with the market. Coincidence. Okay, coincident. I'm going to show you a few more things here. Let me just, okay, so what should we look for during a market correction? Now, we're going to look for these same characteristics even when we're not in a market correction, but the time where you really have a really golden opportunity in front of you is during a correction, because this is where you're going to get a lot of the merchandise, the stocks that are doing really well, these earnings. Remember, we talked about the earnings. Well, they're delivering the earnings, so their fundamentals are coming through. But because Mark Ritchie talked about the spring being depressed. That's something that O'Neill used to talk about. Because the market is not doing well and you're in a bear market, it holds these stocks back, and they don't make very big gains, or even if they do make a gain, they don't make nearly the gain that they would make once there's an appetite for stocks overall. So what happens is you hold the stock price back, but as the fundamentals come in, what's that doing to the valuation? It's improving it. It's creating this roaring monster that's waiting to come out and jump out into new high ground. So this is where you want to look very carefully for, number one, stocks that are hitting the new 52-week high list, or that are close to hitting new highs. I don't even touch a stock if it's more than 25% off its 52-week high. I'm not even interested in it. That's one of my cutoffs. And the closer to a new high, the better. All right. So you're going to look for stocks that correct it the least amount from its highs during the correction. This is the exact opposite of what most people do. Most people go and they look for the stocks that are down the most. They say, oh man, Facebook's down 75%. What a bargain. I got to grab this thing. It's not going to go out of business. It's Facebook. Coca-Cola, they're not going out of business. They're around for 100 years. They may not go out of business, or they may. Some of these big companies do go out of business, but it may underperform for the next decade. Okay, so just making the case that a company is not going to go out of business, or that it's a quality company down in price. Once again, differential disclosure. Does it really make sense? I mean, if it was just if trading stocks was as easy as just buying quality companies that we all know when they're down in price, well, why wouldn't everybody be rich from stocks? I mean, that's about as basic and easy as it gets. I mean, find the greatest companies, and when they're down, buy them.
Yeah, Mark, I'll just add too, I feel like probably 80% of my success I would ascribe to maybe internalizing and committing to what you just said in that last tangent, the idea of differential disclosure. If the company's so great, why is the stock performance so lousy? And focusing on the idea that The market is smarter than me or you, and people, you know, they're going to be new companies setting up in these patterns, breaking out long after we're both dead and gone. And this was going on before we were here. It's going to be going on after. And you just have to accept the reality is most people are not comfortable buying stuff maybe they're not completely familiar with. So they wind up getting trapped in all these old names that are performing terribly. And right now is a perfect example of that. We could rattle off 20 names that everybody's been trying to bottom pick now for 6 to 12 months that are probably on average over time dead money for years, while they're going to miss the great opportunities that are setting up right in front of their eyes.
Yeah, it's a bias. It's a buy low. You know, you heard the saying, buy low, sell high. It's a bias. It's, you know, and also people don't want to do the work. You know, why isn't everybody doing this? They don't want to do the work. You know, I mean, and they don't do the research. They're you know, I have friends that you know, read every consumer report and did research for a month on buying an $800 TV, but it'll plop down 100,000 on a stock on a tip. Because Kramer said something or their friend said to buy it in 2 seconds. I mean, they just don't respect the risk. It's really bizarre, but that's the reality of it. Okay. So let me go back to the list here, and then we're going to show you some examples of these things. So stocks that surged the fastest off the lows and the largest percentage movers, stocks that are building bases, stocks that are outperforming the market. Again, you don't have to be moving up to outperform the market, to have the relative strength increasing and the line hitting new highs. You simply could be moving sideways in the stock and the market's getting clobbered and it's going down. Also, we look for when we start seeing a lot of stocks doing this. When you see a number of stocks acting this way, that's a good sign. And then accumulation in the major averages. When you start to see the volume coming into, that's usually the later signs where you're starting to see accumulation in the major averages. We're going to go into all this in more detail, and right now I'm going to show you some examples. So again, here's where you get that leverage. Here's the Amazon chart that I was talking about before. Here's my buy point. Here's the leverage. You see, the market doesn't really go anywhere, but you get all this outperformance. But as I pointed out before, prior to that, you see the market's underperforming. So the relative strength line here, this little blue line right here, is picking up quite nicely, right? Let's see here. Same thing with Chipotle, CMG. You see the market is moving down, the stock is moving sideways, and that creates the relative strength line improving, right? And you get that leverage. Here's the leverage I'm talking about. See, I bought it right here. You got this really nice leverage. The market didn't go up nearly as much as the stock. So here's the fast rebounders. Just a few examples just to show you off that list that we just talked about. So Cisco Systems, let's go all the way back, and then I'm going to show you some ones currently. Cisco Systems back in 1990, going into 1991, October of 1990, had an IPO, spent some time moving sideways. We had the bear market. The bear market bottomed in October of 1990. This stock came ripping off the lows. In 10 days, it was in all-time high ground. And that was the beginning of a 70,000% move. Had a quick pullback here, and it was off to the races. Okay, well, let's look at something like Peloton. And of course, this didn't go on to become a Cisco, but made a nice move. Same thing, off the lows, right? Here's the COVID bear market, for lack of a better term, the bear market that when we had the COVID scare in the beginning here, right off the lows, we're back in new high ground, all-time high ground in 18 days. Very quickly, pulls back, turns up, very similar to the Cisco situation. And look at the leverage you get in the market, right? Boom, it's gone, and it makes that big move. Goes from somewhere in the neighborhood of $30 or so up to, I guess this is 140. And that big leverage. The market certainly didn't make that type of move. All right, here's DocuSign. DocuSign, a couple of things that look great about DocuSign is, again, you see you're in an uptrend here. 200-day, you're in an uptrend. Market is in a clear downtrend here. If you put moving averages, this is a stage 4 downtrend. So you have that outperformance, and then it's in new high ground in just 10 days off the lows, right into new high ground. And that's what gives you, boom, that leadership. Look at the leverage you get. Big leverage, right? This is what it looks like in real life. Here's Teladoc, right? These are, and I'm using these recent leaders to show you that there was some writing on the wall. You know, Teladoc really had some writing on the wall here. I actually bought some right here. I don't remember. Were you buying this too? I can't remember if
I bought this actually. I owned it earlier and then I bought it again. I traded this a few times and did real well on it.
I thought we had a discussion about this at this time. I can't remember, but I thought we had a discussion. But this stock is holding up in an uptrend. It didn't even during this. Look at this bear market here. You're below the 200-day moving average, right? This stock doesn't even go below the 50-day, let alone the 200. This one looks very similar to Amgen in 1990, almost identical to how Amgen was acting. And that was one of the reasons why I bought it here. It pulled back. It was just acting so strong, excuse me, off the lows. It was back in new high ground in just 3 days, right? Excuse me, I'm sorry. Follow-up buy point just a little bit later. And I thought I had a chart of that. I'm going to take a break because I'm choking to death over here. And we're at the end here. I got a tickle in my throat. So let's take a break.
A little color on this one, Mark, is this was a perfect example of a stock that I actually held through that entire correction because it held up really well and it had come out of a prior base beforehand. And again, to sort of the market intelligence, the market was, demonstrating the fact that, online Teladoc medicine, post pandemic was an area, a potential growth area. And yeah, this stock turned out to be, another one of these super performers, through the correction, and didn't even close below the 50 one time when the market, pretty much crashed. I think we lost 35% in the NASDAQ in 3 or 4 weeks.
Sorry about that. I was on mute. I got some tickle in my throat and I'm coughing like crazy over here. All right, we're going to wrap this up. This gave you some perspective. We're gonna come down to a more focused view. We're gonna come down to an overhead view when we come back, and we're gonna really get into some specific timing and starting to look at entry points, what we call pivot points, and get even more specific and get more tactical. So when we come back, we'll come back to that. Mark, thanks a lot. For your
absolutely, this is where it starts to get really fun. So yeah,
it's gonna get a lot more
hang
fun.
on to your hats. That's right.
That's right. We have a lot more. There's much more to go. So hopefully this first induction or introduction has been helpful, enlightening, maybe overwhelming. But again, we're gonna put it all together for you in coming days, and you're gonna see how this all culminates. All right, I'm going to go compose myself, and I'll see you guys later. Thanks, Mark.
Absolutely.
See you guys later.
All right, I was about to jump in a little early to save Mark there, but otherwise, that will wrap up today. This is still definitely the shallow end of the pool. We're going to start getting towards the deep end tomorrow. It is a much more what I would refer to as fun day tomorrow. Like Mark mentioned, a quick reminder, 6 p.m. Eastern time. That is when the replay will be. We'll have the room opened up 30 minutes beforehand. And again, with any questions, I do use the same login links for all sessions and replays for all 5 days. So same login information, same link. And for the questions you can send, don't rush to send them all to me. Try to collect your thoughts, reference page numbers, be specific, put them all in a single email, if at all possible. You can imagine with the hundreds and hundreds and hundreds and hundreds of attendees, my emails are going to blow up here, but we'll get through as many as we can starting tomorrow after the curriculum. So tomorrow, again, get your rest. Will be about a 5-hour session again in total, plus or minus, and we will reconvene in a few hours again this evening. Thanks all to everybody. We're going to close the room down here in just a couple moments. So do use the email bob@minervini.com. We'll get the emails directly to me, and hope everybody had a fun day like I know I did for the 13th time doing this. Thanks.